Talk Viewpoint. I'm Chantel Leeson, your host. We are the online talk show, and also we're actually a virtual, I'm going to say we're like a virtual resource library for financial investors, for high net worth, ultra high net worth, family office, and family-owned businesses. And I consider it a resource library because many people, when they are looking for ideas to invest their money, particularly family-owned businesses and high net worth investors, they want to get a little information first. And sometimes they want more than what they're being told by their local advisor. They want to have an objective way of looking at things. Anyway, I interview people all around the world and around the country. And today I have a special guest. He was here. He's from a return visit from a couple of weeks back. This is Dr. Victor Chukwuemeka, and he's an economist from the United Kingdom. And I'm going to turn it over to him. And we talked a lot about a lot of things. How are you, by the way?
Very well, thank you. Thanks for the introduction. Very well, thank you.
We talked about a number of things in our last visit. We talked about the economy, the divestiture from the United Kingdom from the euro.
Yes, indeed.
Conditions around where you are and also where I am. I know we're in euphoria here because we're looking at our election upcoming, and you just had yours.
We have indeed, yes. Very interesting.
So I'm going to turn it over to you. Tell us about that. You do a lot on research for the economics on real estate, and not just in the United Kingdom, but around the world. I'm going to let you just take the stage here and tell us about what you do and how you're able to help people.
Yes, well, I run a company called Affluent Asset Analytics. As you say, we help family offices, high net worth individuals, etc., to invest their funds in real estate, be they physical properties or on the stock exchanges. And these are mainly in 4 different parts. The majority of them are retail outlets, offices, and industrial warehouses. We do a few hotels as well. So what we do is to forecast growth. I've been in this business for quite some time now. So we forecast growth through rental growth and income yields. And we determine what the long-term, medium-term, and short-term forecast will be for our investors. So they have diverse portfolios and assets, and they want to know where they're going to invest their funds. And I produce this research for them. And not only that, but I make sure that I fully explain why I think, for example, Lithuanian warehouses might be a good investment vis-a-vis, I don't know, Slovakian hotels, for example, so that it helps them diversify their portfolios and get the best out of their funding. And that's generally what I do. So part of that work also is looking at the green aspect of real estate funding, because that's now become a major thing now. People want to invest in green buildings around the world, and that's becoming very, very big now. And I do concentrate a lot of my efforts on the green aspects of that, because if we're going to reach net zero, as you know, in this country by 2050, we're going to have everything, whether it's car emissions, whether it's housing, whatever it is. Everybody has to pull together towards that end. And those actual assets at the moment are proving to be quite valuable, and people are wanting to know about those kind of things. So I go around the world looking to see where the growth areas are in those kind of real estate markets, and provide that kind of information to the investors, and they're quite happy to get that kind of information. The other bit of my work also is looking at economic shocks. Now, economic shocks are one of my, I would say, my main forte as far as economics is concerned, but I have transferred this into real estate. What people want to know is, when there's an economic shock, what's going to happen to their real estate and portfolios, their investments. So if, for example, there's it could be a small economic shock, like a money supply shock, for example. How's that going to affect real estate prices in, I don't know, rental growth rates for retail outlets, for example, in the United States? Let's say the Fed increases rates. What might happen to the retail sector? Is that going to be more valuable? Are people going to be more online or more in the retail outlets? All these things really matter, and people want to know how these shocks are going to affect the real estate market. And my sort of premise for economic shocks was when I was a very, very young boy. I started to look at the euro when the euro was touted as being the in thing in 1999. I did promise myself that I was going to study a PhD and make sure that I explained to people that this wasn't such a good idea, because when economic shocks happen, it's going to make certain countries rigid and others more flexible. And I couldn't see how two different countries were going to align themselves together, having one single currency and one interest rate. So I made that my thing, and I've now transferred this thing into a something that I've also proven, because look at Europe now, it's very much more rigid than it was before the euro. But I've also transferred it into my real estate sort of investment strategies, where I make sure people want to know what's going to happen when an economic shock happens, what's going to happen to their portfolio. And I use something, I won't bore people with it, something called orthogonalized impulse response functions. Forget about that. All you need to know is what will happen to your real estate portfolio if economic shocks happen. And they happen all the time. So it's very valuable information for the clients.
And we call it market correction here.
All right, something different.
You're calling economic shock, you call it market corrections here. What do you think interest rates, now I know interest rates affect everything. Correct. Interest rates affect your ability to buy real estate. And I want to look at real estate from a different perspective. For the average person, that interest rate affects whether or not the average person can afford to buy a house.
Correct, yes.
Share a little bit about that for our audience.
Yes, well, if I was to take the United Kingdom, we've obviously had, since COVID since the start of the financial crash, interest rates were at rock bottom, and they were for about 12 years before COVID started. And then COVID happened and it went even lower. But then obviously we had the war in Ukraine, and we had, the Russian invasion of Ukraine, etc. And that was the main economic shock. Interest rates having to go up because inflation rose. But all sort of raw materials, cost of raw materials, etc., increased, and we need to sort of stop people spending. Now, personally, and this is just a personal opinion, and I've got into a lot of arguments with economists and also people, that's a cost problem. It's the cost of the raw material rising. That's not a demand problem. For me, it was not a demand. It wasn't the fact that UK residents were demanding more. It was the fact that inflation was rising, because the costs were the cost of raw materials, i.e. oil, etc., from Russia, were having to find it in less supply than it was. So obviously the price went up, and that was putting pressure on our prices, and everything that raw materials I used to make obviously going to go up. I didn't think that when we were in a sort of recessive period that the government, that the Bank of England, in our case, should have put interest rates up. However, they have done that. Inflation has come down, but that, I believe, is because the price of fuel, etc., has come down for other reasons. So I don't really think that was a sort of a reason to put up rates, because people really have suffered. They really have suffered in the UK. Young people, I was just listening on the radio this morning, young people are not able to buy their own house. Even if they have a deposit of £20,000-30,000, they're still unable to afford their housing because interest rates are so high. And if you put interest rates of 5% onto a capital of, I don't know, £380,000 for a first-time home buyer, that's a lot of money. That's a lot of it's a lot of sort of interest to pay on a mortgage, and people just simply can't afford that. So it's a good thing that it looks like we're now at the top end of that, and interest rates look like they are going to be coming down in the sort of near term. Hopefully, we have another round of the Bank of England meeting, and then hopefully they're going to start putting rates down. We've got inflation down to 2%. That's where we want it to be. So hopefully now the rates will start to go down. People will be able to afford more things and do things they would like to do. And that's where we are.
And that's the bottom line. You need to have money to be able to spend. And if rates are too high, you're not able to spend. Let's go to another part of the market. We're talking about, I just asked about the individual buying a house. How do these interest rates affect? Two questions. One, where do you think interest rates are going to go? And what's the impact on the affluent investor? Because see, they're the ones that invest in properties that are mega-sized structures.